risk is an aspect of any organization. Risks need to be understood and managed. Organizational risk is potential for losses due to uncertainty. Risk management is process of identifying possible risks, problems, or disasters before they happen. This allows any organization or the business owner to set up procedures to avoid the risk, also in minimizing its impact. You need to identify risk before proceeding to plan systematic approach. In return, the organization could get sustainable growth. And in this chapter, we cover 6 types of risk, which is commercial risk, political risk, risk arising out of foreign laws, cargo risk, credit risk, and forex risk.
I will share you guys about commercial risk. If you guys know, commercial risk is one of the types of business risk in international trades. So the commercial risk is not only in international trades, but it's also have in a domestic market. But the international market is a more greater give impact than the domestic market. The factor of commercial risk is first is about lack of knowledge about the foreign market. So in a business have many challenges if you want to know. So if you want to export import, you need to more learn about foreign markets. So if that you can more easy to get on the export import. And then the second factor is inadaptability of the export product to the condition of foreign market requirements. And then the third one is a longer transit time. So you cannot expect you can get quick in export import. So the export import have a timeline. So you must do, and then they are take a longer to transit in transit. So the next is the varying situations to be handled, and you cannot expect before you want to do an export import. And the last factor is about competition. So many competition in currently, and so many competition in this industry, export import industry. Price realization is a get of the products in exports make market influenced by changes of exchange rates. The home currency and of foreign currency can affect the price regulation. And then the second one, changes in import duty or tariff barriers. The second one, the third one is the changes of a transport cost. So transport cost is have many changes time by times. And then the last one is a change in a foreign market characteristic. So based on this commercial risk, the solution is you need to minimize using a forecasting technique. And then you need to keep carefully on the changing business conditions because of the concern of the country. And then also you must to keep on track about changes of the world economy.
Political risk is one of the barriers to international trade. Political risk means a risk that will be borne by investors as a result of change or political instability in a country. The instability that can affect this investment return is as a result of change in government, legislature, foreign policy makers, or military control. This change in political power can occur if a political party succeeds in winning a general election in a country that practices the principle of democracy, if the party is a new party that will replace the old ruling party. This situation leads to a process of change of government, such as a new head of government and also new cabinet ministers. When everything changes, it is certain that the policies enacted will also be improved and renewed according to the wish of the new government. There are also countries that change their system of government by ending the monarchical system of government and subsequently transform into a republican state that is free from the elements of monarchy. In addition, there are also countries that face the uncertainty of the political situation, such as coup, civil war, and rebellion. A coup usually stems from a chain of majority support in a country parliament, an individual being too long to be the head of government for a democratic country, and a win-win situation between two political parties leading to a coup by the military. Civil war is a situation where there is bloodshed in an area that has a population of the same race or religious belief. This war can stem from one group of people supporting a different ruling party, and if the victory is in favor of one party, then there will be dissatisfaction by the supporter of the opposing party. While the rebellion describes a situation that is similar to civil war, but the scope of the clash may be larger, such as involving various races in the country holding a revolutionary movement to change the country's administrative system, or people dissatisfaction with government intervention in their personal affairs. War between two countries can also be a major obstacle to these international trade activities. As a result of the unrest and destruction arising from the war will cause the warring country to be backward and unable to rebuild their economy in a short time. As a result, many investors will leave the country because they have a bad loss as a result of the devastation of the war. In addition, war can also result in merchandise carried by cargo operator being captured by irresponsible parties. In addition, war can also result in merchandise carried by cargo operator being confiscated by irresponsible parties. This situation will cripple international trade affairs as the good trade fail to reach the end user. In the end, all this will only give a loss to the industry, as the public has lost confidence in the efficiency of investors. With regard to the risk arising from foreign law, it will bring several things that need to be emphasized. Among them are the influence in law in domestic countries. This is because every country in the world adopts a different legal system. Accordingly, every trader or investor must first study the law of country before they decide to enter the country. For example, in Malaysia, the country banned the entry of goods from Israel on humanitarian reasons in solidarity with Palestinian independence. Therefore, trader or investor from Israel must ensure that the country they want to invest in does not restrict their country trade freedom. In addition, in the event of legal action by foreign authorities, the situation will make it difficult for traders and investors to deal with it due to the complicated litigation process and the high legal costs required as it involves international law. For example, there are some Muslim countries like Saudi Arabia that practice an Islamic legal system that is sometimes not understood by traders or investors coming from the West and the Far East. This significant difference will lead to disagreement that may allow them to fail to continue transaction in the country. If they are found guilty of violating local law, then the court will prosecute them according to that legislation. If there is no suitable lawyer to defend them, then here will pose a problem for them to handle the case. So here, facing this problem, can appoint an arbitrator as a mediator who can resolve the issue and legal action they face. Therefore, every risk that exists in international trade must be addressed efficiently and can be resolved wisely by all parties who handle it so that everything goes well as planned.
Another type of a business risk in international trade is a cargo risk. Transportation of a cargo is undergoing radical improvement over the periods, and most of the goods are using transported by sea. In a marine perils, you have the risk in a transit long because of storm, collisions, theft, leakage, explosions, spoilers, and fire, and a high sea robbery. So that is the risk if you in a cargo risk. More extraneous perils of incidental risk. Incidental risk is a time you want to loading, you want to moving the products or somewhere else. So that is a more risk on your with your product. War perils is also in a cargo risk. It can make a severe war on the cargo risk. Every exporter should have a working knowledge of a marine insurance. So that is kind of the solution on cargo risk. You need to get insurance. So if anything in with your product, anything happen in your product, you can use your insurance to make sure your product on a cargo is be safe. It is always possible to transfer the financial loss resulting from perils of a sea and perils of in a transit to professional risk barriers known as underwrite principle of marine insurance, and also equally applicable to insurance of the air cargo also. The International Chamber of Commerce in terms set out of each party rules and responsibility with regard to export risk to cargo risk, the best work of a forwarding agent.
Now we move on to the credit risk. Credit risks are inherent in credit transactions, more so in international business. International business is invariably riskier than the domestic trade. Credit risk is not the same whether one sells the goods in domestic market or in foreign market. Success in international business depends on the ability of the exporters to give credit to importers on the competitive and favorable terms. Export business has become highly risky as selling on credit has become very common. Exporters and importers are sought after, so it is but natural they dictate terms as there are many exporters competing for the international trade. Insolvency rate is on the increase. Balance of payment difficulties has severely affected the capacity of many countries to pay the import price. However, offering credit has become unavoidable to the exporters to face the competition. Two issues stand before the exporters are: the exporter must have sufficient funds to offer credit to the buyers abroad, and the exporter should be prepared to take credit risk. What is the meaning of credit risk? It is the inability of payment by the importer or inability of borrowers to pay back debt. Once goods are sold on credit, risks arising in realizing the sale proceeds are known as credit risk. It is the inability of payment by the importer or inability of borrowers to pay back debt on the due date. Now you got some ideas what is the credit risk about. Then what is the solution to cover credit risk? Almost countries have public sector organization to cover the credit risk for the exporters. In India, they have Export Credit Guarantee Corporation of India Limited to cover export credit risk. In short term, it's called ECGC. ECGC functions under the Ministry of Commerce and has a board of directors representing government, banking, insurance industry, and the exporter itself. The importance of ECGC is to ensure smooth functioning of Indian exporters by minimizing the risk associated with the payments emanating from other nations and assist the Indian exporters with better access to credit facilities from banks and other financial institutions. What does the ECGC offers for exporters? Number 1, it offers an array of credit risk insurance covers to Indian exporters against the loss with respect to the export of their goods and services. Number 2, it provides export credit insurance to cover from the banks and other financial institutions for enabling exporters to find better service from them. And the third, it offers overseas investment insurance to Indian companies investing in joint ventures abroad in the form of loan or equity. How does ECGC help the exporters? ECGC provides the insurance protection to Indian exporters against the payment risk. It helps the exporters in a number of ways, which include 1. Guiding export-related activities. 2. Making information available with respect to various countries with its credit ratings. 3. Making it easy to get export finance from the banks and other financial institutions. 4. Helping Indian exporters recover bad debts. And the 5th, providing information on the creditworthiness of foreign buyers. ECGC further ensures exporters' credit risk against both political as well as commercial conditions and guarantee the payment to exporters. Okay, for Malaysia, we have Exim Bank, which offer our exporter and importer to do business by providing credit insurance. The Exim Bank cover the following risks, such as commercial risk, which is insolvency of buyer. 2nd, economic risk. In example, blockage or delay in the transfer of payment to Malaysia and imposition of import restriction or the cancellation of valid import license. And last but not least, in condition of political risk, such as war, revolution, or disturbance in buyer country. Okay, that's all for the credit risk.
Foreign exchange, it occurs when the invoice is prepared in foreign currency. That means it happen in other countries than the home countries lah. Next is if using LC and foreign currency undergoes fluctuation, then bank will bear the risk. Okay, foreign exchange risk. The risk of investment value changing due to changes in currency exchange rates. Then risk that an investor will have to close out a long or short position in a foreign currency at a loss due to an adverse movement in exchange rate, also known as currency risk or exchange rate risk. Okay. This risk usually affect businesses that export or and import, but also affect investor making international investment, what we call FDI, right? Foreign direct investment. If we want to invest in other countries, this foreign exchange must also affect it. Then we must do financial risk management, is the practice, which is the practice of creating economic value in a firm by using financial instrument to manage exposure to risk. Foreign exchange exposure. Foreign exchange exposure is a measure of the potential change in a firm's profitability and net cash flow and or market value or net asset due to a change in exchange rates. That the effect in a company, when we as example, when a US company sell a foreign buyer and accept the buyer currency for payment, the US company bear the risk that the foreign currency depreciate. Then it will receive fewer dollars once the foreign currency is converted back into the dollar. Okay, three types of risk from foreign exchange is a transaction risk, and lastly is economic risk. Okay, first of all is a transaction risk. When a firm or individual has a receivable or payable in a foreign currency, the foreign exchange rate may change, causing an increase in the liability of the home country's currency or a decrease in receipt in the home country's currency. The risk of changes in the expected value of the contract between its signing and its execution as a result of unexpected changes in foreign exchange rate. Whoever make a contract denominate in a foreign currency bears transaction risk. Okay. Passive transaction risk management. It will denominate all contract in domestic currency. This is a possible strategy for companies with market power. Do nothing about transaction risk. This is a possible strategy for companies with a large number of small contracts in a large number of currency. Hedging for the transaction risk is insuring against transaction risk to reduce or eliminate the effect of unexpected changes in exchange rate. You can hedge only a market rate. The effect of expected changes in exchange rate are incorporated in this market rate. Hedging is insurance. The purpose of hedging is to reduce or eliminate risk, not to make a profit. The purpose of hedging is to manage firm foreign exchange exposure by minimizing home currency outflow or payable account or liability of for the liability for the company or individual, and maximizing home currency inflow and or other account receivable or asset for the company or individuals. Okay, natural transaction risk hedging. We must centralize cash management to net all offsetting transaction which are long and short in the same currency. Time, lead and lag offsetting businesses transaction in the same currency. And lastly, create offsetting businesses transaction in the same currency. Okay, next is gain and losses from exchange rate changes that occur as a result of converting financial statement from one. This is translation, right? Okay, translation risk. When a home country entity is required to consolidate its foreign subsidiary income statement and balance sheet into the home currency, exchange rate may change, causing an increase in liabilities or decrease in asset as measured in home country currency terms. It means the company, the big firms that have a subsidiary in a foreign country that have exchange rate when do a currency exchange currency when do accounting. There is a gain or losses from exchange rate changes that occur as a result of converting financial statement from the currency to another in order to consolidate them. Okay, to the hedging transaction risk is the same way as a transaction risk. This means we must use the same currency. It appears as investors are indifferent to foreign currency transaction gain and losses. Okay, there is three market market transaction for the risk hedging. First is forward market, future market, and lastly is money market. This forward in my left, in the under the forward, and future market and under the future market line. Okay, for forward market, there is for any currency, for any maturity, but is illiquid. For forward market, it's a self-regulated on the current market. There must a contract with dealer and require creditworthiness. Then have a cash flow. The cash flow on when is a matured. Settled by executing contract, and lastly hedged by buying forward the short currency or selling forward the long currency. But the future market is only a selected currency, standard contract, standard maturities. There is no short or long currency. The future market is liquid, can be liquid. It's government regulated exchange based market. They're based on market. Contract with exchange require margin account and market to market daily. Settled by offsetting trade. It's settled by offsetting trade. Hedged by making a transaction whose gain or losses offset those of the underlying position. Forward and money markets. Money markets can always be used to synthesize forward markets. Money market rates are used to set the forward market rates. Money market transactions are likely to be more costly than forward market transactions. Since three transactions having their own bid-ask spread are required to duplicate one market transaction with one bid-ask spread. Okay, money market transaction appear on the balance sheet, but forward market transaction do not appear in balance sheet. Okay, economic risk. For the last risk is economic risk. This is the effect of exchange rate change on the long term expected income stream, expected net wealth of home country stockholder. This risk is usually managed with physical location of asset and liabilities. Changes in competitive position as a result of permanent changes in exchange rates. Every company buying or selling abroad, or even just competing with foreign company has economic risk. As example, Maybach has economic risk from manufacturing its automobiles in Germany, but for export to the United States, where it compares with Rolls-Royce manufactured in England. By incorporating foreign exchange risk solution into broader business strategy, we can help protect profitability by managing exposure to exchange rates, whatever our risk appetite may be.
Risk management provide a means of mapping a testing process and optimizing controls to detect and prevent error. A quality control plan summarizes the potential errors in some situation and how it intends the risk of these errors. Quality control is actually more the inspection of quality management. Quality control in this context means a set of procedures intended to ensure that product or service meets the requirement of the client and customer. The specialized agencies and councils carry out all of these quality inspection. Exporters with good track record carry out inspection on self-certification basis. And then there are three methods. First is consignment-wise inspection. Second, in-process quality control. Third, self-certification. In terms of procedures, there are in total of 7 steps. Each consignment is subjected to detailed inspection. The following procedure is applicable to all the notified products by EIA, Export Inspection Council, other than those for which the in-process QC system, quality control system, and self-certification is applicable. The 7 steps are: first, application to Export Inspection Agency; second, inspection and testing; third, packing and selling goods; fourth, submission of report to EIA and issue of inspection certification; next, issue of rejection note; and last one, the number 7, appeal against rejection note. Procedures in process QC, quality control, is manufacturing units, own declaration, highly quality conscious, and conduct to route quality control. Procedures in self-certification is manufacturing units, freedom to certify, proven track record, and not receive single complaint during past 3 years. Thank you.